Mark Zuckerberg's company has lost $100 billion in market capitalization since hitting its peak on Feb. To Drew Ungerer, Getty Images. Over the last half-decade, few stocks have been more beloved by investors and Wall Street analysts than Facebook. No wonder, after a rocky initial public offering in 2012, it has rolled over one obstacle after another, including the shift to mobile computing and the rise of photo sharing. It delivered revenue and user growth that surpassed even the most optimistic projections. By the end of last year, Facebook had 2.2 billion active users. Its stock rose 53% last year, single-handedly accounting for 3.7% of the 21.8% gain in the standard Dow Jones Indices. By early February, its market capitalization had surpassed $560 billion, making it the fifth most valuable company in the index. By then, Facebook alone accounted for nearly 2% of the S&P 500 index, which means that anyone who owns a broad-based stock mutual fund or index fund probably owns Facebook shares. Sophisticated investors and institutions, too, have considerable exposure. Goldman Sachs analysts reported last month that Facebook was the second most widely held stock, after Amazon, by hedge funds. Over 90% of Wall Street analysts covering the company deemed Facebook a buy in early February, even though, at $195 a share, its price-to-earnings ratio, a common valuation measure, was a lofty 35. The average ratio now is about 24. Historically, it has been about 15. It was, as Wall Street pundits like to say, priced for perfection. Whatever else can be said about Facebook's recent tribulations, this much is certain: its situation is far from perfection. After revelations that data harvested from Facebook may have been used to try to influence Britain's vote to leave the European Union and the United States presidential election, the social network giant faces multiple investigations in both Europe and the United States, along with potentially profit-crimping regulations and limits to its use of data. And investor retribution has been swift. Since hitting its peak on February 2, Facebook has lost an astonishing $100 billion in market capitalization. Its stock was trading midweek at close to $153 a share, a decline of nearly 22%. It rebounded by about 4.5% Thursday morning. With Facebook's plunge, investor concerns have spread to other social media and internet stocks with lofty multiples, like the so-called FANG stocks: Facebook, Apple and Amazon, Netflix and Google, and Twitter. They accounted for more than 10% of the S&P. Since 2014, Facebook has been one of the hottest stocks in the market, but its recent troubles have caused it to lose about a quarter of its value. People who own an index fund need to realize how important Facebook is, and how big a role it and the FANG stocks played in the market's rise, said Howard Silverblatt, senior industry analyst for the S&P Dow Jones Indices, who oversees statistical analysis for the S&P. Social media hasn't faced much regulation, and now there's a cloud hanging over those companies. In the midst of past Facebook euphoria, few saw this coming. One that did was Aira, a robot that uses artificial intelligence to make stock recommendations. Aira, an acronym for Artificially Intelligent Equity Research Analyst, put out a sell recommendation for Facebook last fall. So did Brian Weiser, a senior analyst at Pivotal Research Group who covers media and internet companies. Although he was positive about the stock for most of its long climb, he downgraded Facebook to sell last summer based on regulatory and advertiser concerns and what he now considers systemic management issues. Not only was it a lonely position, but the stock went up and up. Mr. Weiser told me this week. But I thought the market was wrong, full stop. I didn't know what the catalyst would be, but at some point revenue growth had to slow and the margins go down, he said. There are practical limits, and I felt investors were looking at Facebook in much too positive a light. They just ignored all the bad things, and there were a lot of them. Then, when the news broke this month that a British firm, Cambridge Analytica, had used Facebook data for voter profiling, Mr. Weiser said, he thought it was the most significant thing that had happened to Facebook since it became a public company. Most people hadn't given much thought to how their data is used, he added. But this really exposed the potential abuse. This is digital advertising's original sin, and there's going to be a reckoning that even now I don't think most investors fully appreciate. The other Facebook skeptic, Aira, can talk, but Wells Fargo, whose global internet analyst, Ken Sena, developed the robot along with Brian Healy, wasn't making its wunderkind available for interviews. but based on AIRA's published comments, it issued its sell recommendation after analyzing the frequency of negative mentions in the media of Russia's use of Facebook to influence the presidential election, as well as fundamental valuation and technical factors. AIRA uses artificial intelligence to read and analyze 500,000 pieces of data per day gleaned from the internet. It currently analyzes more than 1,600 stocks. Wells Fargo has stressed that AIRA remains in experimental mode, but one potential advantage is that it removes all human emotion from its analysis. Thus, AIRA was indifferent to the fact that nearly every other analyst had a buy recommendation on Facebook. With Facebook's plunge, investor concerns have spread to other social media and internet stocks.